bid your neighbor a good morning and how do you do. But it's great to be able to get together at least like this. But I wanted to share with you real quickly before I jump into the introduction of our guests is our building is coming along really, really well. And if any of you would like to come by, Gar, and get a walkthrough of what we've got going, it might be best for some people to wait until it's done because some people can't kind of see the end of the rainbow on some of that stuff when it's under construction, but it is going to be stunning. The facility is going to have a 60-person auditorium that can be closed off and be very, very private for a very private presentation. But it's a sunken presentation area, so it'll be different levels of fixed seating for about 60. And then the walls begin to open up into the classrooms, which are expanded by 20 feet to the north for extra square footage in those classrooms. It's actually going to be a stunning facility. It's got its own private entrance. It'll have a catering kitchen, a nice big boardroom. And the reason it's got a catering kitchen is we really do plan on that being a source of non-dues revenue. Many of you know that we haven't increased our dues here at GAR for many, many years. I think 2008 was the last dues increase that GAR had. Wow. Now, you've had several from NMAR and NAR along the way. And we get blamed for those because it's on your GAR bill, but that's okay. We'll suck it up. And just to let you know that our goal is to get all this done and to make a profit enterprise out of the time we don't have realtors using the building. We're prioritizing, of course, your use of your building, but that we'll be actively renting that space as event space, which is really sadly needed in Albuquerque, sorely needed, I guess I could say, is needed in Albuquerque, space that's affordable for people to rent and to have events. So just know that that's the goal there. That's why it's bigger than you might think we would have replaced. But the renovation is just about complete. They're finishing up on, the sheetrock, the floor finishings, tile work. All those things are in process. And again, please stop by. We'd love to walk you through the facility if you get a few minutes to come by and see us. If you're here picking up lock boxes or meeting clients or whatever, it's going to be a fabulous location. The office next door, University Point, as it's been called, your board voted on a name for that facility next door, and it's at 1645. We do have a letter of intent from a firm that wants to rent half and possibly the entire building, which would be great. It'd be a long-term lease, would cash flow within a period of time for us. So that project as well would be a profit center for years and years to come, to the benefit of the membership and to relieve the need to increase dues any more than we have to in the future. Nothing scheduled as far as dues increases that I'm hearing in the near term, and hopefully if we can pull this off and generate nice revenue from these projects, we'll avoid that. So it's a little after 9, almost 5 after 9. So I'd like to go ahead and get started with our presentation this morning. I want to introduce to you our guests, and this is something that should be really beneficial to everybody. Whether you're just getting started in real estate or you've been at it a while, it should be really, really interesting for you. A perspective from a tax professional or a couple of tax professionals. And they come to us from REDW, which is a very well-respected, long-time member of the Albuquerque community in terms of CPAs and tax preparation and tax accounting and so forth. Very, very good firm. Brandon Remley, he's a CPA with REDW, and he's a tax principal, is his title there. He has over 20 years experience in public accounting and specializes in providing tax consulting and advisory services to businesses and family groups. And they're really particularly interested in making sure that you all know that they know about real estate and how your life works as many of you independent contractors, and some of the options that might be helpful for you as you plan your future and you plan your tax preparation year to year. His partner in the business there is Leslie Aron, CPA with REDW, Senior Tax Manager. She's experienced in tax preparation for nonprofit, corporate partnerships, and individual clients. So if you would please join me in welcoming Brandon and Leslie as they discuss your future, your business, your enterprise with your career in real estate. Please welcome them, and guys, we'll turn it over to you.
All right. Well, thank you for the great introduction this morning. We're happy to be here to speak to all of you about, tax planning and possible 1031 considerations that could affect your business. As Kent kind of went over it a little bit already, is that we are pretty specialized and have a lot of experience in real estate, whether it be construction, real estate management companies, people who are just doing flipping houses or doing all sorts of other things with real estate. We've got a real wide breadth of experience in that area, and both Leslie and I have spent a lot of our careers in working in those areas. So we're happy to be here today to present to you. I just want to start this whole thing off. I mean, this presentation is designed to be informational to you, not considered full-on tax advice for you to use. We would recommend that you either enlist our services or consult your own CPA to make sure that tax planning situations and things work out for you well. Going forward, we're really going to have this presentation into about 3 different sections, and we kind of want to stop after each one of them to give you guys an opportunity to ask questions. And we would encourage you to unmute your mics to ask questions whenever you want to do that. We really do want this to be an interactional experience for you so that we can get the best opportunity we can out of that. If your question ends up being something that's more along the lines of something to your personal thing, we can talk about that later offline. But if it's something that would be of beneficial use to the entire audience, of course, we're happy to answer any questions, whether they're part of our presentation or not. So the 3 different kind of areas that we're going to look at is we're going to look at maximizing your deductions and reducing your taxes. We're going to look at your choice of entity styles and how that affects your tax impact. And then we're going to go over the 1031 rules and have some examples on that over, kind of what that would mean for deferred gains, what your depreciation looks like, and things like that going forward. So I'm going to hand it over to Leslie to start talking about our maximizing tax deductions and minimizing taxes.
Good morning, everyone. As Brandon mentioned, we'd like for you, if you have questions, please feel free to unmute yourself and ask during those areas of time that we've allowed for some questions, and also feel free to use the chat. All right, so maximizing deductions. Just a few tips and tricks that we wanted to share is be really diligent in making sure that you're keeping track of expenses. Anything that you're using for your business, make sure to keep track of that and keep it as a deduction on your tax return. And then the next point we have here is spend money to make money, not to save taxes. So in other words, if there's anything that you want to do, make sure that you're keeping track of it. And if there's a way that you can save taxes, if you're doing any kind of expense for your clients, for yourself, mileage, vehicles, anything like that, they'll give you some kind of tax benefit. So make sure that you're keeping track of those and only spending the necessary expenses. Don't go out and buy a car to save yourself some tax. Then the next one here is the IRS always knows what you've made, but they don't know your expenses. So they're going to have record of all of the income that you have, but you can take expenses that they don't know about. So you can use anything you have, cell phone bills, anything like that as expenses also.
Yeah, I mean, we really encourage you. One of the big things about that is that a lot of people wait till it's tax time to take care of all the tax implications and things like that. We really recommend that you either look at either monthly or quarterly, at least summarizing all your expenses and your income items to know where you are, just so that you can properly set money aside in a separate account to pay into taxes, whether you pay them in quarterly payments or you have other methods of doing that depending on your type of entity structure. So, record keeping is a really, really big piece of what you do because, like it says here on the slide, the IRS knows what you make. They don't know about your expenses, and they're not going to go through your bank accounts and all that to help you maximize your deductions. So it's really up to you to make sure that you're getting the most bang for your buck for the money that you're spending and making sure that you're able to deduct that and taking the maximum amount of deductions that you can.
All right, so business versus personal expenses. We really encourage all of our clients and everyone who's starting in business to set up a business bank account. With that business bank account, you can have a debit card, or you can also set up a credit card account, just making sure that all of your business expenses go through those. As Brandon mentioned, doing any kind of reconciliation for your income and expenses on a monthly, quarterly basis, that'll really help you to make sure that you're keeping track of those expenses. Anything business run through those accounts, and then it's easier at the end of the year to kind of figure out what categories they're in and what your true expenses are. Fixed assets like vehicles, just making sure that those are titled in the business name, everything going through the business, make sure that you can still get those deductions on the returns. And title and insurance, all of that needs to be done in the business name to be eligible for a deduction. And loans, those also must be done through your business. If you do those personally, it doesn't give you any debt basis on the return, so you just want to make sure any loans related to your business going through the business name.
Yeah, I mean, it's really important to keep everything segregated into the different, between your personal life and your business life. That's where one of the biggest pieces come in, where if the IRS comes in and looks at it, say, well, you're kind of mixing everything back and forth, that having this separation is really important to prove that you're operating this as an actual business and, looking at it for profit and doing everything that you need to do to make money and to have, a profit interest in the whole thing. So, I know a lot of the times on loans, they'll ask you to personally guarantee them and that kind of thing, but putting them through the business name instead of your own, even with a personal guarantee, is helpful, just so that you can keep that separation between your personal assets and your business assets.
Mind if I ask a question real quick?
No, go ahead.
On that, so doing it through the business name, we're doing the business to our own, right? No LLC or anything like that. I'm just doing real estate under my name.
We would normally recommend that you at least get an LLC for, we're not here to give legal advice, but it helps you keep a little bit of separation, and it's really, really easy to do, just to kind of set yourself up with the state. You can do it on your own there's all sorts of different sites online that you could get an LLC through. But if you end up not getting an LLC and doing it personally, it's still an option. It's not that you can't do it. It's just that there are some preferred ways to handle these.
Well, thank you.
Okay, so some tax saving ideas for real estate professionals. So mileage. Mileage is one of the most important deductions that you can take because it adds up really, really big. For example, in 2023, the mileage rate is for every 1 mile that you drive, you get a deduction of 65.5 cents. So a lot of real estate professionals drive 10,000 miles-ish. That's a huge $6,500 deduction just by keeping track of your mileage. There's several ways that you can do that. You can do a mileage log, write down in a notebook, have it in your car, keeping track that way. There's several apps that you can use, starting mileage at the beginning of the year, and then you click a button in the app and it keeps track of what mileage you've driven for business purposes. You can also take a picture of your receipt first time you get gas during the year, take a receipt picture last time you get gas during the year with your mileage at the top, and keep track that way. Apps seem to be the best for our clients. Recommending to use an app is a pretty quick way to do it also, but mileage is definitely one that you want to keep track of since that deduction adds up so quickly. Next one is home office deduction or desk fees. So if you have desk fees that you pay for an actual office space, you can deduct those against your business income. If you're using desk fees, you're not eligible for the home office deduction. So it's kind of one or the other. But if you do not have a desk space, a home office deduction can add up pretty quickly also. Education, training, and coaching expenses. So if you have a business coach through your real estate company, those expenses are deductible. A lot of the times those coaches require monthly or quarterly meetings, and those fees are a deduction for your business also. Your continuing education, any trainings that you may have, all of those are deductions also that can add up pretty quickly. Closing gifts. If you're giving bottles of wine or knives that have your logo on them, if you give flowers for closings, any of those types of things are also business deductions that can add up pretty quickly, especially if you have significant closings during the year. Cell phone. Cell phone is another one that is a good deduction. A lot of people don't have their cell phone bill paid through their business, but that's one thing that you'll want to keep track of also. If you can estimate what percentage of that cell phone bill is for business, that's a deduction on your return also. Marketing and advertising expenses. So business cards, signs, if you do brochures or when you have a new listing and you put out mailings, any of those types of things also run through your business account for business deductions there. Medical insurance premium deduction, that's another one that is really beneficial. If you're paying any kind of health insurance, you just want to keep track of that. A lot of people, that doesn't go through their business account either. You can put it through your business account, and another easy way to keep track of those things. And then the last one we have noted here is retirement plans. So a lot of people have 401ks, IRAs through their individual selves, but that's also a good deduction if you can have that against your business income. There's a variety of different options that you can have when it comes to retirement plans, and the limits for what you can put into them during the year are pretty significant also. So if that's something that you're interested in, reach out for help on those items.
Yeah, I mean, like Leslie had talked about, the mileage thing is really, really big, and they keep continuing to increase that benefit. On mileage, the other side of that is that you can use a direct expense method where you go through and keep track of all your receipts throughout the year. It would include your insurance, repairs and maintenance, depreciation on the vehicle, and that kind of thing. And then what we do at that point is we compare what your mileage would have been compared to all those expenses, and then take whatever's most beneficial for you. So that's a good option to have. It's good to keep track of both just to make sure. I mean, normally you would keep track of your gas and repairs and all that stuff through your business expenses anyway, so that you'd be able to maximize that deduction there. The same kind of thing happens with the home office deduction. There is a simplified methodology that basically looks at your square footage that's exclusively used for business purposes. And I think it's $5 a square foot right now. And you could just take that $5 a square foot multiplied times the number of square feet that you're using for your business and take that as a deduction against your business income. The other side of that is you can look at all your utilities, you can look at your your property taxes, your mortgage interest, stuff like that, rent if you're paying rent for a space instead. You can look at the percentage of your square footage over the total amount of your house and then multiply it times each of those things to figure out what would be the most beneficial to you, including a possible depreciation on the space that you're using. I thought that there was a question in there about a app that we recommend. I think we were talking about one a little bit earlier. Which one was it, like Strive or Stride?
Stride Tax, I think, is one that's a good app. That one is mostly for business expenses. The mileage in it is probably not one of my favorites, but it still will track it for you. Mm-hmm.
And like I see a little comment here too about QuickBooks does a good job of doing that too if you're putting them in there. One thing, it's not a bad idea to kind of, if you keep a calendar of what you're doing throughout your days and kind of have your listings kind of put on your calendar and that kind of thing. I mean, that'll help substantiate what your interest is at that time too, what mileage you can take and that kind of thing. So that's something else to take. Was it Stride?
It's Stride Tax. Let me see if I can find it on the App Store real quick.
Okay, I'll keep going while she's looking at that one. I mean, the bottom line here for what you guys are doing for real estate expenses is you want to spend money to make money. You don't want to spend money just to save taxes. So if you're for tax savings, if you're spending $1, you're only saving maybe 40 cents on that dollar. But if you're using that dollar to make more money, it's okay to pay more taxes if you're making more money. Is kind of the bottom line, and then we can help kind of plan the other things that go along with that to make sure that everything's being tracked appropriately and that we're able to get you the right deductions for stuff as you continue to make more money. And the thing we'll get into here in our next section is why your choice of entity is important for that, because it'll help minimize taxes depending on your entity structuring. I see some other people here mentioning Expensify is another one that does that. There's plenty of them out there. I think if you just searched anything on your app store right now, there you'll see about 10 or 15 of them that come up to use that. It's just the main point here is make the effort to do that, because should the IRS ever want to come back and audit your returns and look at that, they will want substantiation for the mileage that you're taking on the return. So having something in place is better than guessing at the end of the day. So we just recommend that you do take some effort to go ahead and do that. A couple notes on things like medical insurance premiums. If you have a spouse and you're on their medical insurance plan, that's all being paid for through their employment, so it's not something that would be deductible on your own personal. So that's just kind of a note on that end as you're looking for those deductions. Retirement plans is a big one that I see a lot of real estate agents missing. One of the big things about this here is that you're really moving money from one pocket of yours to another pocket of yours, and you're saving tax dollars to do it. That new pocket is a lot harder to get into should you need it later on, but it's something where you're just kind of keeping your own money and moving it over, and then you're giving yourself a savings and that kind of stuff to be able to have funds when you decide that you want to retire. So I kind of want to open it up a little bit now for questions on these things here before we kind of move into another section. Feel free to unmute yourself or we'll put a question down in the chat.
So you said if my spouse is paying for her medical over there, that doesn't count as an expense if I'm paying for it, not that they're paying for it on my part.
Well, if you're paying for it and covering your spouse, then that does count. But if you're like, say, if your spouse worked at REDW and we provide a health insurance plan for that, you're on that health insurance plan, then you wouldn't be able to take a health insurance deduction on your return, or sorry, on your part of income for that. That's related to your spouse's W-2.
Yeah, thanks.
What about with military insurance, health insurance? If they're retired and I'm on their policy, is that also excluded, I'm assuming?
Yes, it would be. So if anyone else is covering your insurance, then yeah, it wouldn't be part of something that you'd be deductible for your business as the realtor.
Thank you.
One thing I found is that because standard deduction has gone up over the last years, it's harder to get our itemized deductions to qualify to exceed that. Any thoughts or strategies about that, or just you just track them and see which one's better?
It's more making sure you keep everything inside of a business type structure, whether it be a Schedule C or an S corp or a partnership or a C corp of some kind, because then it will get outside of that standard deduction limitation, because there's no limitation on your expenses inside any of your entity types because they're used to generate dollars. So we've got a question here about meals and entertainment and travel. Meals and entertainment right now, if you're doing stuff at restaurants and things like that right now, those things are 100% deductible, where in the past, those things you've had a 50% limitation on meals and entertainment, sometimes even more than that, depending on what type of meals and entertainment you're getting into. But for deductibility purposes, basically anything that you're doing to help generate income for yourself and to generate revenue, those deductions are going to be allowed as part of your business expenses. So if you need to travel to do something for that, if you have to travel to a continuing education class, that kind of thing is deductible. If you're traveling on a personal trip and try to mix in some business, that's where you start getting into some gray lines and that kind of thing. So you really want to be have intent with what you're doing for travel and for entertainment, and make sure that you do have a business purpose for it. I would normally keep track of the person that you're meeting with, like on the back of the receipt, just write the name of the person and that kind of thing, and that'll really help substantiate that should anyone ever want to come look at it. Looks like another question here. How does the home office deduction affect the taxation when you sell the home? So when you sell your home, there is, since you would have taken depreciation on it if you had done the specific method, like not use the $5 per square foot, that there would be a portion of your home that would have depreciation recapture on it. So you could come to a point where you've gotten an ordinary deduction for something in the past for depreciation that you may now have to go back and pick up depending on whether you have a gain or loss on the sale of your residence. Most of the time, sale of personal residence, you have a $500,000 gain exclusion for married filing joint and $250,000 for married filing separate, assuming that you meet the criteria to qualify for those. So it's just, kind of keeping track of that, knowing that there is a possibility that you could have to recapture or basically pick up a gain on the depreciation you've taken on your home office.
Hi, this is Amanda Mays from Coldwell Banker Legacy. I just wanted to first say thank you all for being here. This is great. I just wanted to piggyback off of the travel question.
Mm-hmm.
If we're traveling, just to clarify, traveling to work, that's tax deductible while we track it. And then when traveling home, obviously we don't account for that. If we're traveling to a showing, for example, and I have to stop at the grocery store because I pick up water bottles maybe for my clients, would that be, would I track that? Just as long as I'm not going home. I wouldn't track going home, just anything to.
So there's a slight bit of complication to that because the way that the IRS looks at it for mileage is they look at trying to consider what is your tax home. And so if you have an office that you regularly use that's outside of your regular home, that place could be considered your tax home, which is where mileage and things like that would start from and that kind of thing. But if you work in your home office, then that's your tax home. And so any mileage you do for business purposes to go pick up things for showings, to go to showings, to go meet clients and that kind of stuff, all that mileage would be deductible. It's just making sure but if you had time to where you had an office somewhere and you traveled there every day, that part would not be deductible because you would basically be going from your personal residence to where your tax home is. And so, but then anything from your tax home to anywhere else would be fine. Or if you go somewhere from your personal home to a showing straight from there, that would be okay too.
Okay, thank you.
Mm-hmm.
Does anyone else have questions? Okay.
Sure.
So you had said entertainment, and I'll do like Top Golf, the membership for the league, and I really do take my previous clients and I leave a spot or two open for new clients.
Mm-hmm.
Is that still deductible?
So, kind of like we look at for anything you're doing to generate revenue. So if your goal there is to meet and do business and that kind of thing, then that would be okay. The main things that really have limitations on them for entertainment purposes are like sporting events and tickets and that kind of stuff. Like things like boxes to the isotopes are not considered deductible anymore and things like that. So, it's a bit of a gray area, but I think it's something if you're using to generate revenue, and it's not just you and your buddies getting together to go play Topgolf League, then I think you're perfectly fine. So, we love Topgolf League too. We're trying to do one in our own office. So, it's a great thing. And yeah, but definitely if you're using it to generate business and that kind of thing, and then I think you would have a deduction for that.
As long as you can back it up, right?
Yeah, like we always say, write down the
Substantiate.
people. Yeah, write down the people who are there with you and that kind of thing, and it's definitely good for that. Question about event sponsorships and that those are marketing expenses. So like getting your name on there and that kind of thing. Like I'm on the board for NAOP right now, and I actually run the golf tournament for that. And so we have a bunch of people from there who come in and put their name on that for sponsorships for to sponsor the event or sponsor holes and that kind of stuff. All that stuff is considered marketing expenses for you, so would be deductible for you to get exposure. All right, I think we'll move on to our next section now is the choice of entities here. So I'll turn it back over to Leslie.
All right, choice of entity. So there's 4 different types of entity choices, and on the next slides we'll go into each of them a little more in depth. So the first one, single member LLCs. This one is just a Schedule C form reported on your individual income tax return, so no additional filings needed. An S corporation, that would be an 1120S tax form separate from your individual return. A partnership is a Form 1065 that's different from your individual return, an additional filing, and then a C corporation is a Form 1120, and that's a separate filing also. So we'll go into single member LLCs. That's the first category. That one is reported a separate form, but it's included on your individual income tax return. So no additional filings other than your regular Form 1040 every year. This one is, there's most people who start in real estate start off as a single member LLC, trying to get your feet wet, making sure that you have the initial stuff required for your business. Most people just jump right into a single member LLC right away. And this one is probably a very popular option. There's really two that we see the most in real estate, and this is one of them. This one, they're generally shielded from personal liability for debts associated with the business. That just means if anything were to ever happen legally against you, this one, a single member LLC, has a difference. So it shields your personal information and your personal debts from business activities. And you can contribute anything into a single member LLC and take cash out of a single member LLC without any income tax effect. So you can, if you're depositing all of your checks into your business account and you need to take some cash out to pay your mortgage, no tax effect on that. This also qualifies for a 199A deduction. That is the deduction that gets, there's different varieties, but about 20% of your income as a deduction. That's the section 199A. And this one, you can take any business deduction against your single member LLC to reduce that income reported on your Form 1040. Those are some of the pros. Two cons is there's subject to self-employment tax. So this one, automatically you're paying Social Security and Medicare employee and employer portions of that on your individual return. That totals up to be about 15.3%. So that's a pretty big tax effect. And then greater potential of piercing the corporate veil. That's just once you get to certain levels, there's additional taxes, additional effects for that corporate veil, and this one you have a greater potential of getting there quicker.
Yeah. So a little bit more on the 199A thing, where that kind of comes from is the difference between tax rates for different types of entities. C Corps right now have a flat 21% tax rate, and the maximum tax rate at the individual level right now is 37%. So everyone say, well, why wouldn't I go be a C Corp and have my tax only be at 21%? Well, as part of to help kind of remedy that situation, that 199A deduction came for individuals to be able to take 20% off of either single member LLC income on a Schedule C, S Corp pass-through income, partnership pass-through income. That would basically help you get back to a little bit closer to where that is. So we'll talk a little bit more about the impacts between the two, all the different types of entities and the tax impacts. But yeah, one of those main ones that Leslie mentioned was self-employment tax. That's the one that shocks everyone the most because it's a 15.3% tax on top of you having to pay your tax rate on that income. So that's when we talked earlier about, make sure you set money aside from every deal to pay these different taxes to make sure you're in line. This is the one that kind of hits people a lot and kind of said, well, wow, this is really big. Is there a way I can do something about this? And we'll get into ways that you can do something about that.
S corporations. This is the other most popular option for real estate agents. Some pros to this one is the income that comes from your S Corp is not subject to self-employment tax. So it's not subject to that 15.3% tax on your return. This one, same thing as with the single member LLC, you're shielded from personal liability. Again, that just means that if anything were to happen to you personally, they can't come after your personal assets because it's separated from the business. This one also qualifies for that same 199A deduction. And the S Corps are entitled to similar adjustments to income. So same deductions are eligible. You can still take mileage, health insurance, all of those exact same things as a single member LLC. Some cons to this one is if you were to take anything outside of the S Corp, they're distributed at fair market value instead of cost basis, and there's some potential tax consequences related to those. If you are an S corporation, you also have to pay a wage to your owner. So if you are the main owner, you have to take a wage, which means that you have payroll tax reports that you have to report. If you want to have withholding, federal and state withholding, you can, but there are all these additional reports payroll-wise, monthly, quarterly, and annual reports that you would have to complete if you are an S Corp. And that's kind of similar along with the greater administrative costs. There's also a separate tax return that's involved in this. And with S Corps, you have to do a little more bookkeeping because S Corp returns, you have to report a balance sheet on the return. So you have to report your beginning and ending cash, credit card balances, any loans, anything like that. So quite a bit more time associated with S Corps, just getting books completed and wages reports done, but you're saving that 15.3% self-employment tax on S Corps.
Yeah, and that's part of the allure to the S Corp, especially for real estate agents, is you really don't have a lot of deductions on your own. Like you don't have a cost of goods sold or anything like that, like a lot of other businesses do that would lower your income. So the main thing that you have there is your ability to look at wages. And so there is kind of a threshold where we would recommend between being a single member LLC and doing stuff on a Schedule C and becoming an S Corp because of the costs and that kind of thing. So what we're going to end up weighing is what is the savings in figuring out a reasonable wage and only paying payroll taxes on that portion as opposed to paying it on all the income that would come from the business. And seeing if you're saving more than that by doing the administrative costs, and then you have some of the other benefits, with retirement contributions and being able to, employ other people and that kind of thing that would come into place with the S Corp also.
And a lot of the times, most of you probably have a transaction coordinator. A lot of the times that's a 1099 employee. They're not considered an employee, they're considered a contractor, so they get a 1099. Once you switch into the S Corp, a lot of people move their transaction coordinator to, since they're already paying a wage and already have those payroll tax reports to file, the transaction coordinator then goes to a W-2 employee instead. C Corps. So the pro to this one is, as Brandon mentioned a little bit earlier, is this one has a flat 21% tax. And same thing on this one as the other two is you're shielded from the personal liability for debts associated with the business. The business and the individual are separate. Some cons to this one is it's harder to get money out of a C Corp. There's distributions that you can pay tax on and dividends that there's taxes paid on. So those can transfer some tax issues that you may not have had in the other two options. Another con to C Corps is transferring of property can be a taxable event. So if you're taking property out of the business to your individual self, transferring it to another entity, those all could face tax consequences. And then this one also has a separate tax return, so that's just a greater administrative cost for this one. A C Corp, like an S Corp, also requires you to file a balance sheet. So you still have to report the beginning and ending cash balances, credit cards, all of those items. So this just has a greater bookkeeping cost also.
The big thing about you see that flat 21% rate and you're like, that sounds great, but the two levels of taxation trying to get money out is one of the big downfalls to it. If you take a distribution or dividend, as it would be called, out of a C Corp, that could be taxed up to 15% on your individual return for that amount coming out, in addition to the 21% that's already been paid. So that can be a little bit of a deterrent at that point. There are other ways to get money out of a C Corp. I mean, you could always increase W-2 wages and that kind of thing, because you would definitely have a W-2 wage if you were a C Corp, because that's the way you would get money out personally to pay your personal expenses. So there are some considerations to that. And I think, as Leslie has said before, this is kind of one of the more kind of one of the options we see very, a little more less frequently. So it's on the, so how much percentage? Okay, so we are going to get into an example of the way that the tax works coming out of the different entity types here in a little bit, but just to give you a little bit of a difference, the C Corp has its own tax rate because it's considered its own entity type, and the S Corp, your tax rate can depend on how much money you're making because everything gets taxed at your personal level. So basically what happens is the S Corp gives you a Schedule K-1, which is basically kind of like a W-2, what you would have seen before, that passes through income to you and then gets taxed at your own personal rate. So if you're making over $500,000, you could be paying tax at around 37%, before you get your 199A deduction. But if you're in something in a lower area and you're in the 150s, you could be around 22 to 24%. So it really just depends. It's going to, at the end of the day, it's going to depend on what your overall personal situation looks like.
Okay, partnership is the last entity type that we wanted to talk about. So this one has some pros for a partnership is there's flexibility in tax filings. So you can have, again, like Brandon mentioned, for the S Corp, partnerships give you a Schedule K-1 that basically reports each owner's percentages of the total income from the business. Then those K-1s go on to each individual return. So this one does not have a flat tax like the C Corp and is dependent upon individual circumstances on the individual return. If you are, partnerships can be LLCs, taxed as an LLC, and if that's the case, then you're, same thing like the others, shielded from the personal liability of debts. Business and individual are separate. This partnerships, you can contribute assets and take assets out of the entity without any income tax effect. You can take distributions if you needed additional cash without any tax effect on this one. They also qualify for the same 199A deduction like the single member LLCs and the S corporations. And then a few cons for partnerships is they do not have a wage. They're guaranteed payments instead, and those are subject to the self-employment tax, which is that 15.3% Social Security and Medicare tax. And the only way for you to take money out of a partnership is either guaranteed payments or distributions. And then if you're a general partner in the partnership, you are liable for partnership debts. So that's one thing that's different from the others also. Partnerships is also one of the entities that we don't see very often for real estate agents, but it is an option that you can definitely look into. And partnerships, you cannot just have one partner. So this one, most of the time, there's sometimes owner and spouse or additional partners that have kind of all deposit all their commission checks in and share in expenses or share in different aspects of the business in total. And this one also has a separate return that has to be filed, also has a balance sheet, so the additional return filing and time for bookkeeping expenses are also a con for partnerships.
So yeah, and mainly when we see partnerships in this kind of areas where you have a group of realtors that are working together that kind of want a flexibility as to, kind of have something to be a little bit bigger, but at the same time still be able to make money on their own, because the partnership gives you the greatest amount of flexibility in the way you can allocate income and that kind of thing. It basically gives you free reign over how you want to do that, because you can structure things in your operating agreement to get people to pay out by, how much they're making, how much revenue they're generating, how much, overall bottom line they're putting in, kind of thing. So there are some options here that can be done with that, but it really depends on what you're really looking to do, like as a business strategy for your different company. Let's see, LLC tax election. So you have one here, LLC. So there's a kind of a little bit of a different thing like with an LLC. Is what I really try to tell people is that the LLC is really a legal definition. For tax purposes, you can be an LLC in a few of the different areas. So as you could be a single member LLC in a Schedule C, you could be an LLC as an S Corp, or you could be an LLC as a partnership. All of those are perfectly fine. In a C corp, you would have to be incorporated, so you would not have an LLC election for that. But the LLC is more of a legal definition than it is a tax definition. We've just after we find out you are an LLC, we've got to figure out what type of entity that you're going to want to be a part of, whether it be yourself personally, or if you have other people, or you're making enough money where it makes sense to do the S corp or the partnership. Then there's different forms you can file to then treat yourself that way for tax purposes. So there are some considerations that we look at here when trying to help choose the type of entity you want to be in, and a lot of it has to deal with how much money you're going to make. Like we said, the spot where you may want to go to an S corp or a corporation or a partnership is really going to depend on how much money you're making. As the S corp option, we really kind of look at the $150,000 to $200,000 range of revenue generation, because what we would have to do is then look at what would you pay someone else to show homes and do that, as opposed to the overall business effect of everything that you do. So in looking at that, we'll look at our example here coming up here in just a little bit, and we'll kind of go over the different options and show where you would take wages, where you wouldn't take wages, and you would pay self-employment tax, and then look at how each of those options and how some of the other deductions that you can possibly take are going to affect your overall bottom line and how much tax you're going to pay. So does anybody have any questions at this point? I want to make sure I don't get too far past some stuff if I don't want to have to go backwards for people. All right, I guess we'll just keep moving forward a little bit on that, and then we'll talk again after we get through the self-employment tax portion.
Okay, so in each of the 4 options that we just discussed, there's different ways to get money out of your business with different tax consequences. So as a Schedule C that's reported on your individual return, you can take distributions anytime you want without any tax effects. Partnerships, same thing. Distributions are how you pay yourself in addition to those guaranteed payments. So you can take either of those. S corps, you'd have to pay yourself a wage, as we discussed, and you can also take distributions from an S corp. As a C corp, you can pay yourself wages and dividends. Dividends are then not deducted at the C corp level as a deduction, but you do pay income tax on them as on your individual income tax return. So that's why sometimes you'll hear the double taxation of C corps. That's in essence what they're talking about, is you don't get the deduction, so you're paying tax at the business level, and then you're also paying income tax at the individual level on those dividends that you've earned.
One of the big things I really hear people talk about is that they think when they take money out of the company that's what triggers a tax effect for them, and that's not the case. So on a Schedule C, a partnership, or an S corp, you are taxed on overall income of the business, whether you take all the money out or not. So say if you made $80,000 in your S corp, and you wanted to take $50,000 out and use it for your personal expenses or anything like that that's above what your W-2 wage is, you would have the ability to do that because you've paid tax on $80,000 already, and you're taking $50,000 out. So you're basically just taking money that you've already paid tax on. So there is definitely a distinction and a difference between what you pay tax on and how you get money out. So distributions themselves don't necessarily trigger a tax effect unless you're taking out more money than you've ever put in. So like if you've taken a loan out and then distributed money to yourself that's in excess of anything you've put in or anything that you've earned, then at that point you could trigger a tax effect for yourself. So, consulting with your tax advisor when you're taking money out just to make sure that you're on the right track is a good thing to do, because catching these things at the end of the year is a little bit weird, and we don't want to trigger an inadvertent tax effect, which would basically give you a capital gain if you've taken out more money than you're supposed to.
And somewhat related to that, we have lots of clients who say, well, I'm paying this much tax, but I didn't get that much money. And that's what Brandon was talking about, is you're paying tax on the income from the business regardless of what you've taken. So that may be true that you're paying tax on income, but you didn't take the distributions to go along with it. And that's often what happens also. So we're going to talk a little bit about self-employment tax. So as an employee, if you're a W-2 employee, you have Social Security and Medicare withheld from your paycheck. And then your employer is paying Social Security and Medicare on your behalf. As a self-employed person, you're paying both of those shares. You're paying the employee and the employer's portion, which totals 12.4% for Social Security and 2.9% for Medicare. Those two added up is the 15.3% that we've been talking about in the last couple of slides. That's the tax that you pay on your income. And then so if you are self-employed, you get a deduction for the 1/2 of the tax, which would be the employer's share. You get a deduction on any of the returns that we've discussed. That's a deduction that you're eligible for. The Medicare threshold is one that changes every year. In 2022, it was $147,000, and in 2023, there's a big jump to $160,000. Once you've reached those levels, you no longer pay the 12.4% of Social Security. You're only paying the 2.9% of Medicare. So it can make a pretty big difference. Once you've kind of reached those minimum Medicare thresholds, you're only paying a smaller percentage of the tax as a self-employed person.
Self-employment tax, like I said, this is kind of the big thing in the room, the big elephant in the room with everybody, and when they come in to start doing real estate, is figuring out this payroll tax portion that basically comes in there. One of the big considerations for this is everyone's kind of saying, well, I want to minimize my self-employment tax as much as I possibly can, or I don't want to pay any. Part of the problem with that is that you, if you don't pay in anything to it, you also won't be able to get any Social Security when you get older. So paying in a reasonable amount is what we're kind of looking to get at, and what we would recommend to our clients to do, to basically be able to make sure that you are getting some benefit from paying Social Security. You're going to get some of that money later on, so you may not have to work as long. And we also want to help you get retirement plans and deductions like that into place so that we can make sure you're taken care of by past the point where you want to keep working. So there are some additional considerations of self-employment tax other than just making sure you don't, or trying to not pay as much if you get any. What if I don't care about getting Social Security tax later on? So someone asked the question is, what if I don't care about getting Social Security payments later on? The other consideration for it, especially on the S-Corp level, if you're going to look to be to pay yourself a wage, is that you have to pay yourself a reasonable wage for the job that you're doing. What we kind of tell people is, zero is never the answer that you can give for having wages in an S-Corp, because that's a surefire way to get yourself audited. And what happens in that situation is then the IRS comes in, changes all of it to be self-employment income, and then you pay all of that 15.3% plus penalty and interest on underpayment of Social Security and Medicare. So, finding something that's reasonable for the job that you would do, like I said, I think kind of the example I would use is like if you paid somebody to do some of the day-to-day operation of your job, like going through and buying things to put on, showings or putting ads together, stuff like that. What would you pay someone to do that portion that you do is kind of what we would look at to help justify what would be a reasonable wage at that point. Seems we have one more question on there, I think. I just skipped over one. It says using my equity to buy a house, how much would be the percentage of the tax? So if you have equity inside your business, that means that you've already paid tax on that income. So if over the years you've built up, you got $50,000 inside the business, that means that that's money that's available for you to take out tax-free because you've already paid money on that. So if you're taking money out that you've already paid taxes on, then you wouldn't have an income tax effect. If you're trying to take out money that's in excess of anything you've had, you could run into capital gain situations where you end up paying tax on it that way. So the thing to look at and consult with your advisor on is looking at what your overall equity is and your overall basis in your business to make sure that you have enough to be able to take out without having a tax impact. So next question is, if in an S-Corp, can you take personal deductions for business expenses or only deduct through the business? Go ahead.
We always recommend that you're running any business expenses through your business accounts. But if you, like, for example, have your cell phone that has maybe the rest of your family on your plan, you can still take that as a deduction on the return, and you just run that through distributions or contributions to kind of offset everything. But you can still take those types of personal expenses that you didn't run through the business on your business return.
All right. Does anybody else have any questions before we go through our example? Let's do it.
Okay. So here's the tax comparison. I hope that you guys can all see it somewhat clear. So oh, cool. Thank you. So the first column is the C Corp. And the second column is an S Corp, and the third is partnership or sole proprietorship, which is the Schedule C. All of the facts are pretty similar across the board. So we're saying business income, your commissions were $200,000, and some of your deductions, you took the standard mileage deduction on the miles that you drove of $6,000. Office supplies were $500, meals $500, advertising $2,000, brokerage fees $1,000, owner's salary. So you'll see that in the first two, the C Corp and the S Corp, owner's salary is $75,000. Payroll tax associated with the owner's salary is $5,738, which you'll notice in the first two columns, those two match. The business income, $109,000 roughly. So in a C Corp, as we discussed, there's the flat tax of 21%. So you're paying tax of roughly $23,000 on the $200,000 of income less the deductions. And then that's all at the entity level. On your individual return, you have the $75,000 wage that you paid to yourself, and then we're saying your tax rate is 24%. So your income tax related to your wage is $18,000. And you'll notice this column doesn't have any income tax on your individual return related to the business, and that's because it has the 21% flat tax at the entity level. And then there's also dividends and distributions of roughly $86,000. So the tax rate on that is 15%. Total tax nets to be about $13,000. Then the payroll tax that you paid on your $75,000 of wages is about $12,000 roughly. So in total, as a C Corp, with all of those facts, you're paying about $65,000 in tax. So we'll move to the S Corp. Same initial facts until we get down to the business tax rate. So S Corps do not pay any tax at the business level, so that's why there's a zero there. All the income is taxed on the individual return. So in the individual level, that $109,000 is taxed at the individual level along with the wage of $75,000. And then the QBID, that's the 199A deduction that we were talking about in the earlier slides. So you get a deduction of $22,000 on your $110,000 of income. Tax rate for this one is 24%. So individual income tax is roughly $39,000 as a S Corp. And then this one shows the distributions taken, same $109,000 of income. They took it all out, and there's no tax on that. Payroll tax on the wages, the $75,000 of wages is still roughly the $11,000. So in total, tax as the S Corp is about $50,000. So you can see there's a pretty big difference from just the C Corp to the S Corp, a $15,000 roughly savings. Then on the partnership, LLC, and sole proprietorship, the facts are fairly similar at the beginning. The only difference is as a partnership or sole proprietorship reporting on your individual return, you don't pay yourself a wage. So you don't have the $75,000 of salary and the payroll taxes associated. So your income's higher by those two. Same thing, there's no business tax paid on this income at the business level. It's all reported on the individual return. So on the individual level, $190,000 of business income, you didn't have the wage, and QBID is the 199A again, $30,000 is the deduction that you get from your business income there. Tax rate 24%. Your total tax nets out to be roughly $38,000. And same on this one is taking all of the distributions, all of the income out. There's no tax on that on either partnership or LLC Schedule C returns. But this one, which is different from the other two, has the self-employment income tax. So your self-employment income was that same $190,000 from above, and 15.3% of that is $21,000. And then nets you out to your total tax of roughly $59,000. So you can see sometimes in examples it's a little easier to see the differences on the different options. As Brandon mentioned, kind of depends on specific circumstances where that level of income is for us to recommend going to an S Corp. But it's usually roughly around $150,000 that we start thinking about making that S Corp election to get you some savings on the self-employment income tax.
Yeah, one of the big things to really consider when you are making that switch into the S Corp area is that if you ever get to a spot where your overall business income is generating a loss, it means that you're overpaying payroll taxes. So that's why it's really important to look at that certain threshold to make sure that you're choosing the right area as to when to make that adjustment and make that change. Because if you're paying less in self-employment taxes as a sole proprietor, it would be better than you paying more self-employment tax at the S Corp level or the C Corp level even, than it would be to make the switch. So it's really, really important on timing in that. And that's why consulting a tax advisor for that kind of situation is something that's really, really important.
Does anyone have questions before we go into the next section? And feel free to unmute yourself if that's easier than typing in the chat.
I just figured that I couldn't type fast enough. My question is in regards to the payroll tax, and you say that, so you're referring to like the Social Security and all that stuff that's going to have to be paid out. So ultimately, my question is, everyone has to pay it. I get that. It just depends on where in the line and how you're organized for it. Then in that case, like for instance, I have an S Corp. So if I'm paying a Social Security, so all that stuff needs to come out in my salary to myself. But does your salary have to be a certain amount? Because I know you have a dividend before a dividend out, which is taxed differently. And I may be jumping again, so I think me and Buddy said we're going to get to this later. But I guess my question is, being an agent, like sometimes you can pull out so much and sometimes you can't. And it just depends. Does it always have to be a set amount in the payroll or in the dividend?
No, it doesn't have to be a set amount. It's something that you determine based on the work that had to be done. So like even if you, like say you had a slower year and you made a little bit less than you had made in the year before, it would make sense to lower your W-2 wage at that point because you're not having to do as much as you did before. So there is some flexibility in making decisions about what you could do. I mean, you may even go the other way too. You said, well, I made a whole bunch more money. So as a way of tax planning, I'm going to give myself more wage to give myself more withholding and all that other kind of stuff. If you want to do things like that. So you can definitely play with the different levels of it. The main thing you want to make sure you're doing is when you're paying yourself a wage is to pay yourself a reasonable wage so that if anyone ever comes and looks at it, that it's not there's not going to be an issue. The real thing that I really try to tell people with like in this situation when you're looking at wages is that pigs get fat and hogs get slaughtered. So if you come in there and have a zero in there for W-2 wages, the IRS is going to come in there. They're going to tax everything at self-employment rates, charge penalty and interest, which is huge on payroll taxes. So as long as you're making a reasonable effort to figure out what a reasonable wage is for what you're doing, then you should be in good shape.
So what was considered reasonable then? I mean, you can't do owner's job. I'm learning all this, right? You can't do owner's job. They're like, oh, I had a great time. I
And that's something that we struggle with, that very same thing, because there is zero definition from the IRS on what they consider a reasonable wage, even though they use that term reasonable wage. That's why we kind of really look at making an effort, kind of looking at what comps would be if you hired someone else on to help you do your business. Like, what would you pay that person? And so looking at things like that way, trying to get some other outside influences and outside information on how you're making that decision is really going to be looked at a lot more favorably. I mean, if an IRS agent comes in and says, well, here I have this, I looked at this is why I'm paying this person that wage, they're more than likely to kind of just say, okay, we're going to move along from here. We're going to find somebody that's a much easier target than you're going to be. So, kind of having some of that information, kind of justifying it with what kind of the revenue that person would be generating, that's another way to do that too. And like us as CPAs, we have the same thing. I mean, we generate a certain amount of revenue and we get paid a certain amount of money based on the revenue we generate, kind of thing. So I think it works can work the same kind of way for you also.
Well, thank you.
Another thing to mention. Oh, sorry. Another thing to mention related to making payroll to yourself, the IRS looks at it on an annual basis. So you can, like we do with several of our clients, is we do a lower rate wage for like the first 2 months of the quarter. And then in the third quarter, we kind of do a quick calculation, and maybe the third quarter you have a big bonus because you did really well, or maybe it was a slow quarter, so you have the low wage again. So it's really not necessarily particular on what you're paying yourself monthly or even quarterly. It's just on an annual basis.
I have a question.
Mm-hmm.
I have a W-2 employee, and she was asking me about a gym membership, and I thought, well, I don't know, maybe this is something we could talk about offline. Is that something if I, as an employer, could I provide a gym membership and deduct that?
Yeah, if it would be considered an employee benefit. The main things about that, though, is that if you're providing employee benefits under plans that are deductible, is that you would have to provide that to all your employees. And if it's just the two of you, that may work out perfectly fine. But if there's like many of you, then you would have a consideration for that, because there's could be different criteria that people have to meet the levels to be able to qualify for those kind of things. But they are acceptable to be able to do as an employee benefit.
Okay. And the other thing I was considering is starting a retirement account for the employee, and that was and I did check into doing that, like a 401k, but the company that does my payroll for me, they were going to charge kind of a high amount, I thought, to just set it up. So does that 401k contribution for the employee, does it have to directly come from, be deducted from their payroll, or is something as an employer I could go ahead and just pay it outside of the payroll process?
It depends on the kind of plan that you're going to have in there. If you have a profit sharing plan and stuff like that, you may be able to do it without having them contribute. But I mean, I'm going to kind of stay away from that. Some of that, for the most part, that's not my super area of expertise on benefit planning and that kind of thing. We do normally leave that over to someone to kind of help you to develop the right plan for what it is you're trying to do. Because if you're doing plans that involve you and multiple people, there are requirements for, to be able to qualify for the plan. There's certain amounts that they would have to be paid depending on what you're being paid and those kind of things. So I would definitely consult somebody, a pension or a retirement plan provider to figure out what's best for you.
Okay, thank you.
All right, so we're running pretty quick here. So I'm going to go into our next section under 1031 exchanges, and just to kind of give you a little bit of highlight over that. I know this is an area I've been asked about by a lot of real estate agents that are trying to help their clients qualify for these. So just some quick little highlights here is, we're looking to defer tax. We don't want to pay gain on flipping one of our properties into another. So we are trying to make sure we qualify for that and make sure that we don't inadvertently trigger a gain. Improve cash flow because you're not recognizing that gain, not having to pay out on higher numbers, then your cash flow situation can be better. One of the recent changes that has happened, I guess recently I would say, is the Tax Cuts and Jobs Act of 2018, is where 1031 exchanges went to only to be eligible for real property. It used to be able to trade stocks or other types of things, all sorts of things under the sun, business entities and that kind of stuff. But that now has been removed from the code to only now qualify for real property. Property held for investment or for trade or business, it can be used in a 1031 exchange. But if you're doing stuff with inventory, a 1031 exchange does not apply to the inventory section. One of the big things here is you must follow the rules to qualify and be within the specific guidelines of the timeline, or else you will run into some problems and trigger gains inadvertently. So I want to start with a couple of excerpts from the code for 1031. Like I said, that here's the main page it starts with is no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for an investment. So you'll see specifically here it does not list the inventory portion, so that's kind of where that part came from before. Exception for the real property rule is that it shall not apply to any exchange of real property held primarily for sale, which is the inventory portion, and special rules for foreign real property located in the United States and real property located outside are not property of like kind. So you can't trade your house in New Hampshire for your house in France and qualify for a like kind exchange. Time is of the essence. I mean, in doing these 1031 exchanges, it's really, really important to make sure that you're qualifying for these and doing the proper identification and doing the exchange of property within the proper time frames. So property must be identified and the transaction must be completed within 180 days from the initial exchange of your property. So if you have property that is not identified in the exchange within 45 days after you've relinquished your initial property, it will not be considered like-kind property. So it's very important to make sure that as you start doing these exchanges and start triggering the different impacts, that you're very well aware of where these timeframes are coming from, because you don't want to get pushed up to the very end of these, in day 44. So make sure that you have to go and identify a property real quick that's going to qualify, just so you don't blow your 1031 exchange. Property received after 180 days from relinquishment of your exchange property is not going to qualify for it either. So you've got to have everything done within that 180-day time frame. And it doesn't matter if that 180 days crosses tax years. It's just that you have to make sure that 180 days is held up to. So failure to meet the requirements of Section 1031 will result in the taxpayer reporting the entire gain on their original transaction, which is, kind of worst case scenario for you. The biggest piece that we really tell people to get into when you start a 1031 exchange or when you're starting to plan it is to use a qualified intermediary to help you follow the rules and timeframes, and they'll keep you apprised as to which different steps there are going to be to qualify for the 1031 exchange. They'll also keep the funds for you in different places so that you can get them into make sure that they're set aside and that all the funds that are coming from your original property are then being rolled over into your new property so that you can make sure you avoid the taxation there. Can you do a 1031 exchange into U.S. territories like the Virgin Islands? That's a pretty specific question. I would have to do some tax research on that. So if you wanted to contact us, outside of this, we'd be happy to look into that for you. So how does it all work? So the funds received in the sale of your original property are placed with a qualified intermediary. Like I mentioned before, they keep them in a separate account for you. They keep track of all your different dates and that kind of thing. So as long as those funds are used to purchase like-kind property, there will not be recognition of that gain. And that's assuming that you're using all of the funds from that original property to roll into your new one. If you have a situation where you're not using all of your funds to roll forward, then you could run into a situation where part of it is like-kind exchange and the other part of it would run into gain recognition. So you'll just want to be aware of how you're using your funds and where they're going. The basis of your new property will carry over from the property you originally exchanged, plus any additional, they call it boot, which is cash or any other property you put into the new service to acquire your new property. So you don't work on fair market value at that point. You work on your carryover tax basis for depreciation purposes and your basis. So basically, you're pushing off the gain between your fair market value of your property at the time of the exchange and the basis that you have in the property right now. So I think like I mentioned just a second ago, if all your funds are not used on the new property, gain can be recognized on proceeds not used. Is a good idea to identify more than one property in case one falls out. That's a conversation I would have with your qualified intermediary to make sure that they're okay with that. Like I said, you don't want to run into something that's going to disqualify from you. So if you identify a piece that you can't close and finish the transaction within the 180 days, then those are the kind of the conversations why the qualified intermediary is there. So I want to walk through a little bit of an example here as to kind of how a 1031 exchange is going to work. So this transaction is assuming that all of the cash that you're getting from your original property is going to be rolled over into your new property. So you've bought a commercial building at a cost of $10 million. You have owned the building for 7 years before depreciation and have taken approximately $1.8 million of depreciation on that. You identify a commercial building with a $17 million price, and your original property is having a fair market value of $12 million. You pay cash for the difference in the transaction between the $17 million and the $12 million, so it's the $5 million. So what we'll look at is your basis of your original property is going to be the $10 million you bought it for, less the depreciation that you've taken to leave a basis of $8.2 million. Plus you've paid $5 million of cash for this new property, and so your new property is going to have a basis of $13.2 million. Even though the fair market value of that property is $17 million, basically what you've done is you've deferred the gain between the $17 million and the $13.2 million until you sell this other property. And if you actually went in and did another exchange after this with this property, that basis would still carry over also into your new property, which you would then continue to defer. So once you would make the transaction to sell the property, then this other deferred gain would come back into play. So what we'd look at for the amount of the deferred gain is we'd have the fair market value of your original property, which is $12 million in this transaction, less the basis that we had at the time of the exchange, which was the $8.2 million. So we'd basically have a deferred gain into this new property you've acquired of $3.8 million. So saving that at 15 to 20% is a very, very significant transaction at this point. And that's why making sure that you're following all the rules to make sure that everything happens in the right time frame and that you're getting the proper credit for what you're putting in to make sure that you're getting the maximum deferral you can. The last piece of this is after you finish the whole transaction, you're continuing over the basis from your original $12 million. You get another $5 million of cash that you put in to depreciate because it's now part of your building costs. So your depreciation expense, the depreciation on your current asset that you've been doing, a $10 million asset over 39 years is about $256,000. Your depreciation on the new amount of cash you put in on the $5 million over 39 years, $128,000. So you'd be getting a yearly benefit of depreciation on this building of about $384,000. So I think we may have had one question that came up in there. I know I may have gone through this a little quick because I'm trying to make sure we stay within our time frame so I can respect everybody's time here. Let's see, is it a good idea? Okay, so we had talked about that. So if anybody else has any questions on it, please feel free to unmute yourself or, so put your question in the chat. Does anybody want to be a tax accountant after hearing this presentation?
No.
So, but yeah, that's really what we're here for, is to be able to help answer questions for you on anything you guys have related to your different transactions. And, a lot of these may not even be to you personally. You may have clients who come in and ask you these questions about different things. Especially if you have somebody who's looking for a realtor who has experience in 1031 exchanges or any of these other types of transactions that they need to get into, getting yourself educated on these things is really, really important.
Saving our money.
Yeah.
Not giving it to the gov.
So at this point, at this point, we're happy to answer any other questions you may have, whether it be 1031 exchanges or anything else we've talked about, or maybe haven't talked about. We've still got another 10 minutes or so of question time for you guys.
Can you make your slide not blurry so I can get your names and whatnot on here and phone numbers? Can you just make it bigger and it makes it up?
Okay, let me see if I can. All right, I zoomed in on them. But we've got a technical guy who's much better at this than we are.
That's perfect.
Thank you, that's perfect.
So, and I know as part of our membership with GAR and our dedication to this organization and what you guys are doing, we do offer a discount on our services to GAR members. So you can, there's information on there. I think Laura will have all that for you if you have questions on that. But, we're happy to work with real estate agents. We do a lot in different real estate areas. And so we're happy to be a big part of the community here.
Thank you so much, Brandon and Leslie. We really appreciate your time today.
Thank you.
Thank you.
Thank you.
Very informative, thank you. I just did a 1031 exchange. I thought it was pretty easy to do.
Yeah, as long as you're not having trouble with properties or anything like that, they're not too bad.
Yeah, as long as you can acquire the property, that's the hard part.
Yes. Yeah.
That's the key.
Staying within those time frames is pretty tough sometimes. You guys know how often things can get delayed, so that's probably one of the most complicated parts of the 1031.
Right.
Yeah, it's making sure that you don't want to jump the gun on your initial sale. That's kind of the problem. And I know it's tough because you may have, a buyer on the front side who really wants to push to have things done, but you need a little more time on the back end to make sure that you're making, doing your other kind of things there. So, I think we had a question.
Like an up leg and a back leg too on it?
Yeah, there can be. Yeah.
Okay.
So discounts apply. So the discount we have right now, I think, applies to tax services. I can't speak for other departments. I can help make that decision on our own side, but we can, we'll definitely look to give you guys a discount on tax services and planning. If you want to reach out for services, we just contact you on email or phone. That is perfect. Either one of us are happy to help you with that. We have some other managers and seniors and supervisors that we work with in our area too, and so we really try to get people involved with somebody that they can call and get a response from within 24 hours. Everybody's got time in that, and, with the way that the CPA profession is right now, I know it's really tough to find people right now, so we really do try to make sure that we get you with somebody and get you answers in a timely fashion.
I have a relationship with Paul Madrid. I was just wondering
Perfect.
if the discount would apply to that.
I would have to talk to Paul. So I can get back with him on that. I'm not sure what that is, but I know he normally tries to wrap everything in together. And actually, if we do tax services for you and you're already working with Paul, we could end up wrapping everything together under wealth and tax and then work something out from there.
Okay, thank you.
So we have a question. What is the impact if after 5 years you turn a 1031 exchange into your primary property you live in? I think that's kind of something we would have to answer on a more personal level to try to get a little more information on. So if you want to contact, either of us, we'd be happy to get you some more information on that, Morris.
I have to fill out my W-9 for my brokerage, and this probably is a very simple question, but I don't know. About my EIN, should I do a single member LLC, or is there a different way? What's my best advantage? Should I even contact you guys personally with regards to that, or?
No, we can answer that. You would want your W-3 to be, if you have a business that you're putting everything under, you would want it issued to that business, no matter what type of entity it was, whether it was a Schedule C, an S Corp, partnership, C Corp, whatever. That way that you can keep everything separate for that purpose. And then when you go to do reporting, that's all issued to you in that number instead of in your personal Social Security number. Where you can run into a little bit of issue is if you have an S corp and they issue it to you personally and use your social, then the IRS is going to look for that to be on your personal return when it should be on your S corp return. So that causes a little bit of trouble. So I would definitely use your business EIN to do that, no matter what type of entity you have.
Thank you very much.
Thank you.
If there aren't any more questions, I think we may end up ending this presentation. We appreciate everybody who attended. Again, if you have any questions for Brandon or Leslie, I can put their contact information at the bottom of the blog down at gar.com so that you can reach out to them as well in the event that you don't have this in front of you. Thank you so much, Brandon, Leslie, and we appreciate your time this morning. We really do. We know you're busy.
Thank you.
Thank you.